What are we not analyzing in today's GDP first look, Francis? What's the big mystery?
The big mystery is not today's GDP at all. Today's GDP will tell us what we already know, which is that this economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade. And if you told most people that last year, they would not have believed you. The big mystery is, what does the next 4 to 6 quarters look like? And this is really what concerns me. It's not recession or no recession this year or even in 2023. It's what do we do if we're stuck in 1% growth for 4 to 6 quarters? That's much harder to trade, much harder for central banks to respond to.
And Francis, what's so important, I featured this earlier, and Justin Fox of Bloomberg Opinion has done great work on it. Powell really skirted yesterday the housing plug-in to GDP, which is if we get yields up, mortgages are slammed, house ownership is slammed, and that means rents sustain and go higher. How does that work into the GDP of the nation?
Well, economists like to say housing leads the market. You nail housing, you're going to get the economy outlook pretty good. In fact, one of my favorite charts is one that shows that housing leads retail sales. So, really focusing on the housing side of the story is going to be critical. It is going to bring down inflation to a certain respect. And it's also very, very bad. Every data point we have on housing is trending downwards. Frankly, Tom, every data point we have across the gamut of major primary data points is pointing downwards right now. There's not a lot of places you could look for optimism, unless you do what Powell did yesterday, which is to call initial jobless claims rise not real, or to question the validity of the GDP number.
3 weeks of it now, and we might have a fourth week of it later. Francis, tell me why the market's been rallying then over the last month, why credit spreads have been tightening, and what do you make of that easing of financial conditions we've seen?
Well, bear market rallies, they get bigger the deeper you get into that bear market. I do not believe what we saw yesterday from Chair Powell was a pivot, although it certainly was the path towards a pivot, and markets care about second derivatives. But what Chair Powell told us is, well, he's data dependent. Unfortunately, I don't think that inflation number is going to come down fast enough in the next 2 to 3 months to take out too much of the pricing for 2022. But what this market is going to do, in my opinion, is price in more cuts for 2023. And gosh, that makes the Fed's job harder, just like we saw yesterday. The weaker the outlook, the more we see those financial conditions fall, the more it offsets what the Fed's really trying to do, which is tighten. Look at the break-evens yesterday. They're rallying. That shouldn't be happening when the Fed's tightening 75 basis points. They're probably not happy.
That's actually funny that you mentioned that, because I was just looking at the five-year forward break-evens, and they've been steadily rising the more people believe in this Fed pivot. So what do you expect in terms of pushing back against this? How does the Fed react to a market that's not cooperating and getting ahead of itself?
Well, I wouldn't be surprised if in the next few days, the next few weeks, we do see Fed officials who come out and really try to walk back some of that, speak to some of the hawkish risks that exist in this market. And that's why I think it's dangerous to make too big of a change in your Fed view after a single meeting. And as we've seen this year and a little bit of last year, you can have these big rallies on Fed Day that are then reverse course the very next day. So Fed Chair Powell told us they wanted to be nimble. I think now is the time for economists and strategists to be nimble as well.
Some people who are watching the show, Francis, are probably saying, oh my goodness, here she goes again being bearish. Tom is saying we're sick of talking about recession. Companies adapt. And we are hearing around the margin signs that the rally that we've been seeing is a signal that we've priced in so much bad news that people are beginning to find value. What's your argument against that?
Well, I'm not sure if the she is you or me, but bearish has been effectively the right way to do this. And if you look at the economy, it is still trending downwards. Historically, what we would see is that when the economy is about 2/3 of the way through its downturn, you can start to look for opportunities. And I will be the first to say that macro does not rule all. There will be pockets of advantage here. I think we should watch. I think the curve will still flatten, but we will reach a point in the next few months where you want that steepener back on. And there are always bottom-up trades to be had. So the correlation on macro, it does change over time. It's not the be-all, end-all, but the macro does not look good. When it does, I'll be bullish again.
Francis, what do our listeners and our viewers do is they jump from forward guidance and the comedy that it was to actually just looking at the data? How do you actually get through a week, get through a month, get through a quarter where you are data dependent?
It's a great question, Tom, because we don't know exactly what data the Fed is looking at. And sure, we asked him and he said, well, we're looking at inflation. We want to see compelling evidence. What's compelling evidence? Probably a few months of month-over-month improvements in inflation that is heading downward. They're looking at labor supply and demand, but not all data, apparently, because there's plenty of data that says jobless claims and unemployment is moving in the wrong direction. So we don't know the Fed's reaction function as much today as we did even 48 hours ago. And that's going to make a lot more market volatility, a lot more two-sided conversations. One of my fears is that we're going to have a lot of Fed officials speaking to both sides of the argument. So the clarity on what happens next has been reduced very significantly. And if you're at home and you're thinking, what do I look at? Well, I'm in the same boat.
Francis, I can sense the frustration. So let's address it. What do they need to do better?
I'm not sure it's frustration so much as how much harder are you making the job of knowing what you're going to do next. And the Fed's job isn't to make my job easier. The Fed's job is to contain inflation and really improve the employment outlook. But what would be helpful is if the Fed had more clarity on what elements of inflation they're looking at. Now, 2 meetings ago, we heard from Chair Powell that he was very focused on headline inflation. But yesterday he said core is the best leading indicator. So I'd love to hear more about what really are you targeting? Because we know that, for example, inflation expectations for consumers are driven much more by gasoline prices than they are by Fed policy. So which elements of this are you really trying to control? And do you fundamentally believe that it's your job only your job to contain inflation? Because inflation came from a lot of places. It's going to take a lot of places to fix.